Thank you, everybody, for joining us. My name's Robert Beatty. I am part of the team here at the C.O.R.E Group. Um, we are talking about long-term care planning today. So long-term care planning, it, it's a tremendous opportunity. It's a tremendous issue. It's one of the most underserved, under-discussed issues in the financial advisory community. I will say it's probably from the client's perspective, uh, our clients have more questions and concerns about long-term care than many in the community, in the advisory community, are talking to their clients about. We're going to talk about an opportunity to address that with your clients at the end of the presentation and what we can do to help you address that question with your clients. Long-term care planning is probably, well, a long-term care issue is probably the greatest financial threat to your clients post age 65, the largest single financial threat to their portfolios, to their net worth, to their financial security, to the legacy that they want to leave behind to those they care about. And whether it's the semi-affluent, affluent, or high net worth space, the numbers and the expenses, the financial involvement of long-term care solutions and needs, it's it's on par with buying a house. It's on par, which is typically the largest single investment that most people in their lives make, is the residence they live in. And the numbers that we'll be talking about today are on par with that type of an investment. And if you have clients with net worth between 500,000 and $5 million, the costs can be a significant double-digit percent of their net worth. And so we're going to address it from that perspective today. But overall, the purpose of today's presentation is to give a very high view, a 30,000-foot view of long-term care planning. What is it? Defining long-term care, defining the needs, defining who pays for it, defining the costs. And the costs aren't merely financial. Quite frankly, the heaviest burdens and the heaviest costs of long-term care is to the well-being of those you care about as they help navigate the needs. Again, core group long-term care planning. I say to someone, a young person that's entering into the financial services business, if you wanted to be a specialist and you wanted to focus on one aspect of financial planning and you wanted to have a very lucrative career, you could focus on long-term care planning solutions. It's less than 9% of the population has some type of a private insurance long-term care solution in place. So what overview today, what is long-term care? Where can I get long-term care services? It's about protecting relationships. It's about costs, financial costs, who pays, favorable tax treatment. The government recognizes that this is a looming crisis issue as our population ages, as baby boomers retire, as Gen X starts getting into their 60s. Things to consider, what solutions are out there, and helping determine what's best for each of the clients. Fortunately, there's more better, more robust, consumer-friendly solutions out today for long-term care planning than there's ever been before. So what is long-term care? It's the care you need when you are no longer able to care for yourself independently and stay safe. A chronic illness event requires that you are unable to perform two of the six activities of daily living. That's the technical definition when you're dealing in the long-term care space as to who's going to pay and when are they going to pay. Typically, you have to have assistance with two of the six activities of daily living. And those ADLs are defined as, and they can occur from accidents. Not all long-term care involves people that are in their 60s, 70s, and 80s. It can be from an accident and being permanently impaired. It can be from a medical condition such as stroke, arthritis, diabetes, where you are physically substantially impaired because of the ravages of those diseases. Aging, sickness, and more prominently today, cognitive impairment such as dementia, Alzheimer's disease, and brain injury. Those diseases, that dementia, Alzheimer's disease, and brain injury, those numbers are skyrocketing. And it's really no surprise. It's because people are living longer. Alzheimer's and dementia weren't such a big deal when life expectancy was 65 because people never got to the ages where that was going to be an issue. They were dying from something else. The activities of daily living are eating, continence, transferring, toileting, bathing, and dressing. These are the six defined terms that if you need to have help with two of them. If you can't feed yourself and you can't get yourself out of bed, that's two of the ADLs. If you can't bathe and you can't dress yourself, that's two of the ADLs that would trigger a qualifying event for long-term care assistance to kick in. So where can you get long-term care? You know, when I first started in the business, it was called nursing care, nursing insurance. It wasn't long-term care. It was, and really the policies were very specific to it would pay for you to go to a long-term care facility. Today, long-term care assistance it can be provided in the home, assisted living community, adult daycare facility, a nursing home, and hospice care. And they're all distinct in what services are provided and where they're being provided. So, you know, it's about protecting relationships. First off, I want to talk about the odds. There is a less than 1% chance in any given year that someone's home is going to burn down, 1 in 385. There is a 1 in 63 chance of being in a car accident in any given year. There's a 1 in 2 chance of having an extended care event in your lifetime. For people over the age of 60, well, let's round it to 70. For people over the age of 70, there's a 67 to 70% chance that you're going to need some type of long-term care in your life before you pass. The odds are very high. And yet people, they gladly insure their homes. They insure their cars because they have to, but very few people insure this risk. And again, the risk, the financial loss of a catastrophic long-term care is the same as or not or greater than the financial loss if something happens to your home. And again, the odds are substantially less. And we'll address the affluent. You know, some people say, "Oh, my client's got lots of assets; they can self-insure." They could. That's not. Why would they, right? I mean, they don't self-insure their house. They sure that their $3 million house burns down, they can afford to pay for a new one out of cash. But do they? No, they buy homeowners insurance just because they can pay for something out of cash. And again, someone that's very affluent, you know, they're not going to the Medicare facility with a shared room. They're going to the Marriott. You know, we have a place here in Scottsdale called the Valley. You know, it's a $400,000 down payment just to get in, and it's, you know, $10,000 to $15,000 a month for basic services, and they go up from there. Again, it's a wonderful facility, and if you're affluent, you're going to that kind of facility. So, what is the impact of caregiving? And again, it's not just the financial. It's 64% of caregivers have depression. It's a huge burden on family members or other caregivers that to continue to take care of someone in need, to help them with the activities of daily living. 70% report missing work because of caregiving, because they've got to take the person to the doctors, that you know the medical requirements and exams and all those things compound when someone's got is in need of long-term care. So they've got to take them to the doctor, get them back. All the, you know, the transporting, being their advocate in the doctor's meetings, all those things. 70% report missing work. 59% of caregivers have at least one chronic physical condition. Why is that? Because typically the caregiver is a spouse, and the spouse is typically same age, pretty same age as the individual that's going through the long-term care event. And because of their age, they typically have some type of a chronic health condition, whatever it may be. $324,000 in lost income for a 50-year-old woman who gives up her career caregiving. And it's not an uncommon thing, right? First off, something like 2/3 of caregivers are female, and a female family member, typically a daughter, daughter-in-law, niece, and you know the family comes to an arrangement. Well, you can quit your job, and we'll support you while you're doing this. And that 320, and that's just income. That doesn't count the lost contributions to 401k, the future gains in their retirement plans that are foregone, all of those things. The average person spends $7,200 out of pocket. And it's not, it's not even intentional, right? They're going to the store and they know that mom needs something at the house and they just, okay, throw it in a cart and pay for it with all their other stuff that they're paying for themselves, paying the deductible on their prescriptions and never, where do they get reimbursed from? And 87% of people surveyed say long-term care costs would be a significant financial strain. Quite frankly, I'm surprised it's that low, 87%. If you look at the most people's financial resources, typically when they're in their 40s and 50s, when they're taking care of this event, 87%. And I'm going to share with you, I've experienced every one of these. I've taken care of my mother. I took care of my aunt in their long-term care needs. I missed many days at work. I'm fortunate that I had the flexibility because, I've got my own business that I could do that. I don't have a chronic, well, I don't have a chronic physical condition. Did I forego income? Well, that would be harder to calculate for myself, but I will guarantee you the $7,200 of out-of-pocket expenses that I was paying during the caregiving of my mother and aunt is a very low number. Um, and fortunately, I also had a long-term care policy in place for my mother that covered the vast majority of the, the upfront or overt expenses. So what does it cost? So for home care, and again, 51% of all long-term care services are provided in the home. Typical cost, and this isn't for 24/7 nursing. This is just someone coming in a few hours a day, maybe 4 or 5 days a week, is about $67,000. It's projected to be as much as $110,000 in 2035. You have community care and facility living. Um, this is going to be anywhere from, adult daycare to assisted living. And again, when I talk about assisted living, I'm talking where they're semi-autonomous and someone checks in on them maybe once or twice a day. Again, you're in the $66,000 range, or it's adult daycare where you're dropping mom off at the adult daycare during business hours while you go do your job. And then you have skilled nursing facilities. Um, Long-term care claims are growing in length. 15% of claims last over 5 years versus 4.5% 10 years ago. And the typical cost for a semi-private room is $127,000 a year, and it's projected to be $206,000. Now, I want to say when they say skilled nursing facility, so my experience is that my mother was in a memory care facility and it was considered assisted living. Now it had a doctor on staff, it had registered nurses, it had LPNs, it had 24/7 skilled nursing care. They assisted with everything. 25 years ago, that would have been defined as a nursing home. But because of all the regulations and the licensures and all that such, they are now registered as assisted living facilities. In Arizona, at least, the true long-term care facilities or the nursing facilities, they're only for acute rehab after they're initially discharged from the hospital. And it makes a difference in the definitions with the policies, but $10,000 a month plus. And my personal experience was it was closer to $12,000 a month just to have a single room um, in a full-on nursing care facility. So what's the total cost? Again, most people start out at home, then they go to assisted living, and then some will then transition to a higher level of care in a skilled nursing facility. And again, when I say assisted living, I'm talking about where someone comes in, they have their own independent apartment, they still functioning, they are still able, but they have someone coming in, and then they transition into the facility. And a lot of the facilities, you start off as it's a senior community, and then they have a wing for the assisted living, and then they have a wing for is now considered the skilled nursing facility, and you progress through those. In 2025, the average costs were $425,000. In 2035, it's projected to be $692,000. Think about your clients, their portfolios, their net worths. Um, Even if they're worth $10 million, it's still not a small dent to their net worth, right? You know, you're looking at a 5% hit. If they're worth $5 million, you're looking at a 10% hit. So who pays? So a lot of people are under it's very common when people, oh, I have Medicare. So first off, long-term disability. Long-term disability covers your lost income, but it doesn't pay for any long-term care needs. So if you become disabled and you're still of working age below age 65, the long-term disability will replace your income, but it is not going to pay the expenses of the long-term care event. The income that you're getting in, which your family was dependent on for their lifestyle, they're going to still need that money coming in from the long-term disability policy to sustain your life as it was prior to becoming disabled. The long-term care event is an expense that's stacked on top of that. It is so long-term care disability really covers no long-term care expenses. What does Medicare cover? Medicare covers only a portion of long-term care costs up to 100 days. 20 days are at no cost, and the remaining 80 days there is, where I think the copay right now is $285 or $287 a day, almost $300 a day, which is close to, you have to pay that as a copay deductible. Anything above that, Medicare will pay for 100 days. And there's some caveats to that. First off, for you to qualify for this coverage, you have to be in the hospital for 3 midnights. And why it's defined that way, I don't know. So if you go in the hospital and you have a catastrophic event and they discharge you after 2 nights of stay, Medicare will not cover any of these costs. You have to be there for 3 nights in a row and then be discharged to a skilled nursing facility, a rehab facility. 20 days, first 20 days typically are covered 100% by Medicare, and they don't really require a whole lot of accountability with regards to your progression. They'll cover the next 80 days with that $287 a day deductible that you have to pay out of pocket. But you have to make progress. If you're not making, for example, if you've been in an accident and you're paralyzed from the neck down, and you've been there for 30 days and there's no hope that you're going to make progress, Medicare will require you to be discharged to a outside private care facility, and they will no longer pay. So the 100 days isn't guaranteed. You have to be showing progress in your rehabilitation and continue to get better for Medicare to keep paying those remaining 80 days. Health insurance does not cover long-term care expenses. Medigap policies, Medicare supplements do not cover any long-term care. I will say what many Medigap policies will cover is that $287. If you have a good med sup, that med sup will cover the $287 a day deductible for the other 80 days that Medicare is covering. So a good Medigap will cover that deductible. Some of the Medicare Part Cs don't cover it or only cover a portion of it. But health insurance will continue to pay your drug costs, the doctor visits, all of those things. They will continue to pay the traditional costs that a health insurance policy will always pay, but it will not pay for the facility. It will not pay for room and board. It will not pay for any of the ADL assistance that you're receiving or are required to receive. One of the most common is self-insurance. I'll just pay it out of cash. I have a rainy day fund. How many of you have clients that set aside $100,000, $200,000, $300,000 that's sitting in an annuity or it's sitting at CDs in the bank, and that's their rainy day fund, right? I'm going to tell you 100,000, 200,000, 300,000 is probably inadequate. And then there's family members. Family members, even the most responsible are not always prepared physically or emotionally or financially to care for loved ones. You know, oh, my kids are going to take care of it for me. Have you asked the kids? And the kids, they call them the sandwich generation. They probably still have kids in high school or in college, and they're paying out substantial money, still supporting their children. They're trying to pay their mortgages. They're trying to save for their retirement. They're trying to do all the things that they're supposed to do for their financial well-being, and then they're supposed to come in and start paying for the cost of long-term care for their parents or their in-laws. It's a substantial burden. So none of these pays for true long-term care expense. Sometimes the family members come through. Some people can afford to self-insure. The largest single payer of long-term care expense in this country is Medicaid. But for you to qualify for Medicaid, you basically have to become destitute. You're allowed to have $2,000 in assets. I could rattle off the rules. You can have so much money, so much in equity retained in your home that you don't have to sell the home to pay costs. You can have one car. If you're married, husband and wife can have one car. There are some the spouse that's not going into the facility also gets to shelter some assets and get some sheltered income. But I'm going to tell you, these are not affluent type numbers that you get to retain. The individual themselves basically has to become destitute, and they can receive up to three. And again, I've got the exact numbers. They change every year. They can, I think it's like 3,150 dollars or $3,800 a month. They can have coming in. But in most cases, for you to qualify for your state, and it's the Medicaid for long-term care is run through the states. The federal government pays block grants to the states, and then the states manage the programs. And each state has different qualifications and what does and doesn't count towards that destitution. But it's not a pleasant experience. Your clients, when people call us up and they say, "Hey, I need help with my Medicaid planning," I struggle with it because our job as advisors is to help our clients become wealthy, to become financially secure, to provide for themselves and their loved ones. It's about growing wealth. It's about affluence. It's about getting ahead and accumulating assets and financial security. Medicaid planning is basically you're trying to figure out a way how to make your client destitute as fast as possible so the government will pay for their long-term care. That's not the best outcome for everybody involved, particularly for the surviving spouse, that after the person in the long-term care passes, what do they have left for their financial security and to cover their needs? So private benefits of long-term care insurance. It provides certainty in your planning and outcomes. We have a great piece. One of our relationship managers created a great piece, and he talks about long-term care planning, not just in buying an insurance policy, but putting the whole process in place. Who has agreed to do what? Where are the resources? And so you communicate that with your family members and loved ones so that when that event occurs, and it's never expected, right? It never happens in a timely manner, and you have to make decisions, like big decisions, in 24, 48, and 72 hours. You have to make some pretty large decisions, and if you get them wrong, it's very difficult to unravel them. And so having a long-term care plan, it avoids the uncertainty. It helps get all the pieces in place. So think of it as this is my emergency plan, or I got my boogie bag packed over here. So when the emergency happens, I just got to grab that bag and I got everything I need in it to get through that emergency, that short-term crisis. Setting up a good long-term care plan. It doesn't just mean buying insurance. It means setting up that plan where all the moving parts, what resources do we have? It avoids physical and financial dependence on family and friends. It protects hard-earned assets. It maintains choice on how and where you receive care. It assures high quality care at an affordable price. It gives more options to stay at home when you need care. It helps maintain independence. It helps maintain family harmony. I mean, the family harmony thing, you know, there's four siblings, and one of the siblings is doing all the work, and the other siblings are completely disengaged in mom and dad's care. I mean, that aspect alone can tear a family apart. It enables your family to supervise care instead of providing care, where the caregiver, the family members providing care, is managing all the other resources that are providing the care. They're not the ones going in and providing the bathing, the toileting, the feeding. They're the ones helping coordinate and make sure that the best resources are being provided to their loved ones. You're a quarterback as opposed to playing every position. It transfers the risk and responsibility from you, your spouse, and your family to an insurance company. One of the great aspects of owning a long-term care policy, the financial aspects, truly the main gist of it, but you also get resources. Every one of our long-term care providers has resources. My personal experience was when my mom fell and she went to the hospital and she was being discharged to a skilled nursing rehab facility. I had all these decisions to make, and fortunately, because of my what I knew at that time about long-term care, and I'll tell you, I know a hell of a lot more now than I did then, was who to call, who can help me coordinate this, where are the resources, how do I find the proper facility? Because it was clear she was going to need to be discharged out of rehab into a long-term care situation. And how do I research facilities? Where are the facilities? What are the costs? What do they offer? which ones specialize in cognitive impairment and two-person assists, all of that stuff. It really helped me get a handle on it. And some of the resources that I reached out to. So fortunately for me, I bought my mom a John Hancock long-term care policy back in 1995 and paid the premiums all these years. Being able to have resources at my disposal, say, hey, here are some resources in your community. Here are the places you can go. That in and of itself was a tremendous part of the long-term care plan. This problem is such a big financial problem for our society that the government has passed all kinds of tax incentives to get people to self-insure. In the original Affordable Care Act, they tried building a long-term care component to the act. The act was already divisive, right? How many people say they hate Obamacare, but they love the Affordable Care Act, right? People say, I love the Affordable Care Act. Yeah, well, it's Obamacare. Well, I hate Obamacare because it's got Obama's name on it, and they tell me Obama's bad. But the Affordable Care Act, they jettisoned the long-term care provisions. Why? They could not. They knew that that they would have to implement a tax, right? So Affordable Care Act says you have to go buy long-term or health insurance. So everyone says, well, that's a tax. Okay, it's a tax, whatever. You had to pay for premiums. The cost of implementing a long-term care solution would have made it so unpalatable that the healthcare side of it, the health insurance side of it, it would have never passed. It would have torpedoed the whole thing. It would have. So they just jettisoned long-term care, and it's the federal government really has done very little since then to address long-term care. Washington State is the one that took the most proactive activist approach, and they basically imposed a payroll tax on everybody that lives in the state of Washington. And they have to pay this tax for the rest of your life. And there's no cap on it as far as income. And the only benefit that it provides $100 a day benefit for 1 year. $36,500 is the max benefit that you can get. For many people, younger people that are going to pay into it, they're going to pay more in payroll taxes than they'd be better off taking what they're being taxed, putting it in CDs at the bank, and they'll have a bigger pool of money at the end of the day. And it's not adjusted for inflation. $36,500. I'm going to tell you that won't pay for 4 months of skilled nursing care. But they tried, and it was extremely disruptive to the insurance marketplace because everyone was scrambling to get private insurance because they said, well, if you have private insurance, you can opt out. So right now, there's currently 14 states that are trying to put a similar plan in place. All of them are struggling with the math to make it work. California was supposed to be the next big one to fall, and that would have been, if Washington State was a pebble causing a ripple, this would have been a meteor hitting an ocean if California did what Washington State did. Fortunately, California, some cooler heads have prevailed and said, wait a minute, man, we're having trouble making this work. They're out there and they're trying to do it, but they can't. So the federal government in the Pension Protection Act of 2006, they have created several tax incentives to get the private sector to start funding it. First off, individual wage earners. So if you're paying long-term care premiums, it counts as a medical expense, and it's deductible to the extent that the other medical expenses are deductible. So if you're over age 65 and your total medical expenses exceed 7.5% of your AGI, you're able to start deducting those medical expenses off of your income. If you're under 65, I think the threshold is 10%. So you can deduct those expenses, and the long-term care premiums count towards that threshold for you to be able to start deducting medical expenses. If you're a self-employed 1099 wage earner, 100% of the premium is deductible. There's no 10% threshold to meet. And you can also deduct premiums for dependents or your spouse. If you're a C corporation can deduct 100% of long-term care costs that they're paying on behalf of an employee, including the owner. And it's a distinction. In a C Corp, the corporation can also pay the long-term care expense for the owner and spouse, and it's fully deductible. It's not subject to non-discrimination rules. You can carve out a class of employees, say everyone over the age of 50 or everyone over the age of 55, or we're going to, it's the discrimination rules are like, are you going to provide it to your 20-year-olds? No. But your 40s and 50-year-olds, it's a tremendous benefit. And again, it's fully deductible to the business and non-recognizable as income to the employee. That is a huge opportunity. And so sometimes when we're doing executive planning in, key man executive planning, trying to put golden handcuff and retention policies in place for key people, sometimes when you got someone who's 55 and 60 and their time horizon is 5 or 10 years and you want to keep them that whole time, instead of trying to do, say, alert an overfunded variable life policy or some other type of non-qualified deferred comp, it's why don't you pay for their long-term care? Why don't you pay premiums over the next 5 or 10 years, and then when they retire, they have this fully paid up long-term care policy that's got a $600,000-700,000 pool of tax-free benefits should they or their spouse need it. And there's no income recognition to the executive. There is no back-end exit strategy that's a taxable event. There is no deferred income, but there's this big benefit. So partnerships, LLCs, and subchapter S corporations. Same rules apply as a C Corp, except for some perverse reason, the business owner can't do it for themselves. They are now subject back to the individual wage to earner limitations as a business owner. I think it's a travesty. I think they should fix that and amend it. That just because you're a pass-through entity, if you're providing benefits to long-term care to your select group of employees, you yourself as the owner should be able to enjoy that same tax-free treatment of your long-term care premiums. And annuity gains, and this is something a lot of people didn't know, and this was a sleeper provision. So annuity gains can be accessed income tax-free to pay for long-term care premiums and to pay for long-term care expenses. So let's say you have a client that 15 years ago put $100,000 in a variable annuity and it's worth $300,000-400,000 now. So you've got a $300,000 gain. Typically, if you start taking withdrawals, it's last in, first out. So you've got taxable gains till you get down to your basis. You can now the provision is that the annuity needs to be a long-term care qualified annuity. And the silliness of that rule is that what makes an annuity a long-term care qualified annuity? It has to have a line in the policy that says this is a long-term care tax qualified annuity. Literally, that's the difference. And most annuities that were sold 10, 15, 20 years ago do not have that language built into them. So there are companies that have annuities that you can 1035 the money into the annuity and take money out income tax free, your gains to pay for long-term care premiums or long-term care expenses. And we're going to get into we'll talk about annuities again when we talk about asset-based solutions. So there are some tremendous tax benefits there for people to incent people to start taking responsibility for this and buying private insurance to fund their long-term care needs. So what are the products that are available? There's traditional long-term care insurance. So 30 years ago, there were 30 plus carriers providing traditional long-term care. I will tell you right now, we have three. We have Mutual of Omaha, Thrivent, and National Guardian Life. They provide traditional long-term care. What are the pros? You can get a spousal discount. You can build in inflation protection. The premiums may be 100% deductible. Many states have what's called a partnership program where you can shelter assets. So in a partnership program, the state says if you buy a long-term care policy that covers 700, or $400,000 of benefits, we'll let you shelter 400,000 of benefits before the state kicks in and starts paying that Medicaid long-term care. So it helps prevent, so you don't have to go destitute to qualify for the state benefits, right? So you have to buy a $400,000 pool of benefits to shelter $400,000 of your assets. That's a partnership plan. And it's the most leverage for LTC expenses for your premiums paid. Typical traditional long-term care, relatively speaking, has a low premium. The issue with that premium in the cons is one, very few policies, they offer short-term pay premiums anymore. They tend to pay. National Guardian Life still still does 10 pay to 65. They even have a lump sum policy. But Mutual of Omaha, it's a life pay. And there's a possibility of rate increases. If you've had clients come into you, they bought long-term care from Genworth 15 years ago, and they keep getting letters, we're going to increase your premium, we're going to increase your premium, right? Because they're non, um, they can't cancel the policy, so, but they can raise the premiums. And the other factor with traditional long-term care is if you don't use it, you lose it. It's like car insurance. You pay car insurance your whole life and you're never in an accident. They don't refund the money to your family when you pass. It's it's true insurance, right? And many of the plans are reimbursement only. Now, some are adding in a small indemnity benefit, but most of them are complete reimbursement, which means you need to incur the expenses. Then you go to file the expenses on a monthly basis to the long-term care provider, and they then refund or back reimburse those expenses back to the person, which requires someone administering that process. Now, many of the long-term care providers, for example, if your loved one is in a facility and the facility bills monthly, some of them allow you to where they're just directly billing or submitting and billing the expense to the long-term care and they're reimbursing back to the facility. My experience was that I had to file the expenses, everything once a month, file a report, and then within 15 days they would refund back and auto deposit into my mother's account the money that was paid out the previous month. Asset-based long-term care. This is the biggest growth sector and probably what I consider the most flexible options in the marketplace. So what are the pros? You have guaranteed benefits and you have guaranteed premiums. When you buy an asset-based long-term care, many of them are single premium, but even if you have a 10 pay to 65, or even a life pay, they cannot raise the premiums. From day one, what you see is what you get. The benefits are guaranteed. You have the ability to get premium back if needed. So many of them have, okay, I put a $100,000 single premium in, I get a $500,000 pool of benefits. 10 years from now, we don't think we're ever going to use it for whatever reason. Many of them you can surrender it and get back 80% of the premium, and in some cases 100% of the premium you paid into that policy, and you get to walk away. Um, the capital stays with the family if it's never used. If you don't use it, there's a death benefit that's paid out income tax free to your heirs, and that death benefit will always be at least equal to or some small percentage greater than the initial single premium that you put in. But at least someone gets it back. It's simple to understand. Again, what you see is what you get. The illustration that the client signs the day you deliver the policy is exactly what they're going to get between now, 10 years, 20 years, 30 years from now. All of it's guaranteed. That ledger shows their guaranteed benefits. It can be a one and done payment or it can be flexible premiums. I talked earlier about someone setting aside $300,000 in CDs for their rainy day fund for this. We would say, let's take 100,000 of the 300,000, buy an asset-based long-term care policy that creates $300,000 of immediate benefits that also have an inflation built into it. And it frees up the other $200,000 for you to do something with you want today or invest it or seek higher returns or gift it to the grandkids, whatever you want to do with it. It frees up $200,000 in assets to do something else with while providing the same amount of tax-free benefits. You can pay with cash or you can 1035 in existing cash value life insurance to fund the strategy. Many times we see people come to us and they have a $300,000 whole life policy they've been paying into for 30 years with $250,000 of cash value. They effectively have $50,000 of insurance and $250,000 in savings. So we say, let's take the $250,000, 1035, and typically we're going to get more than the $300,000 of death benefit the whole life is providing them, and also amplify it into a pool of $500,000, $700,000 of long-term care benefits. The death benefit, should they never use it, still going to be the 300 in a whole life policy. It's a tremendous way to leverage some of those old whole life or universal life policies with high cash values, but the net amount at risk in the policy is very small, so they're really getting very little insurance. Let's take it and see if we can't leverage it where they get more insurance and this giant pool of long-term care benefits. Many of them are simplified issue. They'll ask 5 or 6 knockout questions. Our typical turnaround time is 5 to 7 business days from submission to approval. It used to be faster, but It's because the carrier's back office systems have gotten sluggish, not because the underwriting has gotten any more complicated. So what are the cons? The best leverage is when a lump sum is invested, but it's not required. If we're using it, typically is going to require at least 50,000 of funding, whether you're doing it at 5,000 a year for 10 years or 50,000 lump sum, whatever. You, you know, to really get substantial leverage, that's the minimum funding amount that we have found. And the benefits are reduced over the age of 70, although I will say that 70 is getting bumped out. Carriers are finding ways over age 70 um, to create benefits. But certainly, if you come to us and it's a 75-year-old, we can show you all the options. And sometimes those options are long-term care annuities versus a long-term care life policy. We'll show them to you, but the leverage is quite a bit reduced over the age of 70. And then accelerated benefit riders. Your client's primary need is that they need life insurance. Um, some of the life insurance will provide spousal discounts. They can provide inflation protection. So you buy $1 million guaranteed death benefit life policy, and you add a long-term care rider to it, and you can choose, say, 1, 2, 3, 4% of death benefit can be paid out on a monthly basis. So if you pick 2%, you're basically buying a 50-month pool of long-term care benefits. So if you have $1 million policy and you're taking out 2%, you're getting $20,000 a month for 50 months, right? That's, it's basic math. 4%, it's going to last for 25 months. But again, it doesn't mean they're going to send it. Depends on whether it's indemnity or reimbursement, but it doesn't mean it's only going to last 50 months. It provides asset protection, and I'm sorry, this screen is inaccurate. I apologize. This is a copy scene. So I'll continue to address accelerated benefits. You buy a life insurance policy and you put a percentage they accelerate that benefit. It's income tax free. Many carriers call them chronic illness riders, and some of them are true long-term care riders. Depends on whether they were filed under the 101 regs or the 7702 regs. But you still have the same ADL triggering events. But it's another option where you get both the death benefit and you get the long-term care benefits. Things to consider: daily or monthly benefits. I prefer to do monthly because it smooths out the expenses. Because when you're in a long-term care situation, if you have $300 a day and in one day you incur 500 expenses, it's only covering 300. Whereas if you have a monthly benefit, you can have 500 in one day and 100 in another day, and it gives you a better opportunity to get those benefits out. What do you want the benefit cap to be? How big a pool do you want? And typically it's defined in number of months and number of years, right? That's how they define it. You want $300 or you want $3,000 a month for 48 months, 60 months, right? And then what's your elimination period? Do you want a 0 day? Do you want 20, 30 day, 60 day, 90 day? And the longer the elimination period, the more benefits you're going to get. The shorter, the less benefit you're going to get. What inflation do you want to put in? So 5% inflation used to be the norm and common, but it's become so expensive that it can be cost prohibitive to have a 5% inflation. Most plans that we're seeing now are putting a 3% inflation, and it may lag behind, but if you think in terms of the time horizons, if you're thinking 10, 20 years, 3% can be sufficient. How do you want to pay it? Single pay, 10 pay, life pay, pay to 65? You need to consider, can you stomach potential changes to ongoing premiums? Do you want to have non-forfeiture provisions, which means in a traditional long-term care, it means that you pay into the policy for 10 years and all of a sudden you can't afford the premiums. Well, at least the carrier has to give you a long-term care benefit equal to the premiums you paid into the plan. What are the exclusions of the plan? Do you want indemnity or reimbursement? This is a big topic. Indemnity means that once you trigger the event, if you have a $5,000 a month benefit, they're going to start sending you a check for $5,000 a month every single month until you tell them to stop. That's indemnity. Now, the problem, that may sound great because one, the best thing is that you can have a family member take care of you, right? Because many long-term care plans, they require that for them to reimburse the expense of that home care, that it must be a licensed practitioner, not a family member, wouldn't qualify. So with an indemnity plan, you could still keep a family member helping pay for those expenses. The downside is that I can't tell you how many stories I've heard where the kids kick in the indemnity benefit of $5,000 a month, and they're using it to buy cars, TVs, and vacations, and they're doing nothing to take care of mom and dad. Reimbursement, it requires a little more administration. Um, some of it can be set up automatically between the vendor and the insurance company. Again, it's part of the conversation. And then if you use a chronic illness, is it, how do you want it defined? Temporary. Some plans only cover permanent chronic illness, and other plans will cover a temporary chronic illness as well, where say you've been in a catastrophic accident, but you're going to recover after a year. Well, if that's considered a temporary impairment, some plans pay for it, some plans don't. All of these are factors that we can help navigate for your clients and their needs. Um, we have access to all of the best asset-based long-term care solutions. We have top quality traditional long-term care with Thrivent, Mutual of Omaha, and National Guardian Life, where we have great long-term care annuity solutions. And again, some of those annuity solutions provide leverage. If you put your 100,000 in, they leverage it into a pool, right? It doesn't matter if there's gains or not, they provide a giant tax-free pool on a simplified underwriting basis. Um, we can help navigate, a business funding long-term care solutions. Our case design team's here to help you with all of those and help find the best outcome. Our role is to find the best outcome we can for your end user clients. So what works best? It's an important issue. It's too important of an issue to be left by chance. I'm going to ask that Ryan sends out an email with a piece we just did that addresses long-term care planning, not just from the insurance solution perspective, but taking chance out of the conversation for all those involved. Setting up a plan, where to go, when to go, how do we provide solutions for our loved ones? Um, We're full service financial professionals. And the other thing, so this is what I want to address. If you found this to be a useful presentation, we have advisors that we help them draft a letter. They send a letter out to their client base and said, would you be interested in a conversation about long-term care? A 30,000-foot flyover like this presentation. And then if your clients respond back that they are, we will do this presentation for your clients. We can put your logo on this. We can customize it for your firm. I will do the presentation, or someone else from my team will do the presentation for you and your clients. It's just a way to introduce the idea to your clients. And what we have found is the clients that I've had lots of questions about this. But the other thing is that in the back of their head, they know that this is an issue, but sometimes they don't even know what questions to ask, let alone what the answer should be. And the purpose of this presentation is to begin that conversation, to put some order to that process. We are happy to help you do that. Send a piece out to your clients, asking them if they would be interested in hearing more, and we'll help you present the idea. That's my presentation today. I appreciate everyone's time. I'm Robert Beatty. You can call into our 800 number, ask for the case design team. If you have a relationship manager with our team, you can give them a call. Let us know how we can be of assistance. It's a great opportunity to provide value for your clients, and we're here to help you do it. Thank you again. Again, we're going to send a piece out about long-term care planning. Hope you have a great rest of your day.